digital assets and their underlying blockchain technology tend to focus mostly on their promise, predictions about future applications. But we're now at a crossroads. Some of those promises have been fulfilled, and parts of the digital asset ecosystem look like they are sustainable and will become permanent parts of the financial system architecture, while others still remain aspirational promises. In this session, we're going to examine the current state of play. We'll cover many aspects of digital assets, including crypto, stablecoins, payments, tokenizations, and regulation throughout the world. So let's get started. Let me start with Adib Ahmed from Lulu Financial Holdings. So Adib, your group operates across multiple regions and touches millions of customers through its payments and remittances ecosystem. From your vantage point, how have cross-border payments evolved over the past few years, and what shifts are you seeing today as new digital asset payment infrastructures begin to take shape?
Thank you for having me here at the session today. So one thing that we've always known in the last couple of decades that the future of finance is digital. While this has been an accepted thought, over the last 2 decades, we have seen a very slow but a predictable shift from cash to digital. But what we are seeing at today's cross-junction is a complete rebuild. And this is many factors because, we have many new forms of money that has come into the market. So we have stablecoin, cryptos, the tokenized money, digital assets, blockchains. So there's a different kind of payment methodologies that have come into the market. The last couple of years, the geopolitical tension around the world has fragmented the financial payment ecosystem in each of the countries. Today, you will see majority of central banks wanting to establish their own regional payment ecosystem in all countries. So you have the larger players like UPI in India, in Brazil, you have ANI here in UAE, you have the PayNow in Singapore. And then we have the aspect of the need of the cross-border payment to be seamless, and that requires interoperability between each of these fragmented payment ecosystem. So, with all these new elements of activities that has come in sight, we're still gearing up our entire aspect of understanding how the payment could be much more seamless. I feel that the use of stablecoin is largely increasing in its usage. Even though that if you look at the 24 numbers, we'll see that the payment used on stablecoins is still less than a percentage of what is used on traditional money. So we see that the stablecoins is still in its very nascent form, and there is a long way for the usage of stablecoins to be on the mainstream. In terms of Bitcoin, it's still up in there. We don't have central banks regulations on that aspect. But the good thing, at least from our side of the world, that is here in UAE, the regulator has become co-author of writing regulations. And that's a very good news for all of us here because, they involve us in finding out and understanding this new journey, which is also very new to them. And this allows players like us to assist in getting the right regulations placed because it does not become a bottleneck and it brings in more efficiency to the usage of tomorrow.
Thank you, Adib. Yeah, you mentioned both stablecoins and the role of regulators and industry players working with them. We'll do some deep dives on those. Thank you for setting us up on that. So, Yoni, I want to come to you next. You're the co-founder and CEO of eToro, which is a leading global trading and investment platform. And you allow folks to trade traditional securities like stocks, ETFs, options. We also allow them to trade on the same app alongside digital assets, which are continuing to grow in popularity, not only among retail, but also institutional investors. So it seems like they've been kind of the new thing, the popular thing to be trading. But how long have you offered investment in digital assets, and how important is crypto trading on your platform relative to the other assets that you trade, and what trends are you seeing over time?
Sure. So we started actually buying Bitcoin back in 2011 when it was $5. We should have bought more. And then launched Bitcoin in 2013. We were the first regulated financial institution to offer Bitcoin trading in Europe, then expanded our business from Europe to the UK, Australia, Singapore, Abu Dhabi here in the US. And we started our business in capital markets, stock trading. I think what we've seen over the last 12 years, this is a generational asset class. It's not only about the technology, it's about a new form of capital markets. It's a global capital markets. We have today over 500 million people that actually trade and invest in digital assets across the globe. So this is far beyond already the inflection point of usage. More people actually invest today in digital assets than in the stock markets directly. And when we look at the younger generations joining eToro, and many of the people who join eToro join in their early 20s into eToro with as low as $50 or $100 to start basically their investment journey and then grow with us and grow their investment with us over time. And we actually see that today crypto in many cases is actually their first asset class. So this is a generational asset class where younger generations actually start first to invest in crypto assets such as Bitcoin and Ethereum, and we suddenly find our role. We used to say always that eToro caters to younger generations, me at Gen Y, now we're catering to even younger generations, and I find myself actually trying to explain to Gen Zers why they need to diversify from digital assets and crypto assets into the stock markets to diversify their investments and take less risk. And actually, sometimes it's hard because their expectations are very different. But again, if you think of the size and scale, we're thinking already in trillions. It's already a $4 trillion market cap economy. If you think of size and scale, again, it's like comparing newspapers to blogs. So we recently went public, very proud to go public on NASDAQ this year. But when you think of the number of publicly traded companies in the US, it's only 4,000, actually down, I think, from about 8,000 to 4,000 over the past decade. If you think of the number of crypto assets out there, it's over 100 million types of crypto assets out there. So basically, people are just launching new tokens, every day launching new types of assets, new types of tokens. So that new ecosystem opens an opportunity. If you think of the number of small, medium businesses, just if I remember correctly, just Europe and the US, 65 million small, medium businesses that up until today didn't really have access to capital markets because capital markets are reserved for significantly larger companies. I remember starting eToro, my father told me you need to get to $50 million to get public. By the time we got public 18 years after, we're at almost $1 billion revenue. So the thresholds continuously go up of traditional public markets, but there's a huge need of capital formation for many other businesses across the globe. So it's not about only the ability to invest into digital assets. It's also about what do you invest in. And when you invest on the other side, there's capital formation. So it's a new type of capital formation, which is global, which is already there. And now we're seeing what's really interesting with regulatory updates coming both from Europe with recent MiCA and now with probably the friendliest administration anybody could hope for in the US with Chair Paul Atkins continuously talking about capital markets moving on chain. And that's where we are now at that next stage of growth for digital assets. It is the inevitable $100 trillion move of traditional assets and new type of assets onto the blockchain. So we're talking about probably the next 10 to 20 years, a huge shift of assets, both existing ones like stocks, very popular right now, tokenizing the stock markets themselves, in what I say is capital markets copying crypto markets, because our customers are used to trading 24/7. So when we started eToro, everything used to be only market hours. Now suddenly stocks trade on eToro 24/5, now shifting to 24/7. Why? Because customers who trade crypto 24/7 expect also stocks to trade 24/7 and fixed income to trade 24/7. So what we're seeing is capital markets copying crypto markets in behavior, which means 24/7 transferability. And you're seeing traditional assets, everything from obviously the dollar, stablecoin. Now, by the way, $350 billion of stablecoin, which means it's one of the top 10 holders of treasury in the world, is actually young digital asset investors are actually I think the 5th or 6th largest holders of treasuries in the US. So you see that move of traditional asset classes and then real estate, bond markets, private markets, all moving on chain. So very exciting times to see that process from $2-3 trillion into $100 trillion over the next 10 to 20 years.
Oh, that's great. I mean, tokenization, stablecoins, we'll get to that in just a couple minutes. I can't help but notice when you listed the countries that you were in sort of in order, you got to the UAE and everybody else before you got to the US. So we'll get back to that. You said the current administration is the most pro-crypto, but we'll contrast that with your experience in the past. So I want to now move to Yuval, who's the co-founder and CEO of Digital Asset, which is a leader in the use of blockchain technology to improve capital flows. As I mentioned, the title is From Promise to Permanence. And if you go all the way back to the sort of the original Big Bang, the Satoshi white paper, right? It was one of the promises of blockchain technology is it would create a new financial architecture. Tell us about the Canton Network and how it's fulfilling the promise of blockchain.
Sure, and maybe I want to just build on what Yoni said. I really like, he said generational asset class, and kind of at the end, I'll summarize, I think we're seeing a generational user experience, right? This point of real world is copying crypto. I think what we're seeing is what's happening right now is that markets are adopting a new user experience. And that user experience is not going back, meaning everything on chain, it's not just 24/7, it's settlement times, it's the ability to take my assets and pledge them as collateral against many types of products. Like if you think about today, if I go to a traditional broker-dealer, I cannot take my Apple stock and really lend it as a retail customer. Yet in crypto, I can lend my crypto into many types of products. So if Yoni, for example, wants to offer his clients to go into private credit, which is a really good asset class, but he says to his clients, well, it will take you 20 days to settle this, or you cannot trade it, or you cannot pledge it as collateral. They're going to say, what is this stupid asset class? No interest. No, thank you. So I think that this user experience is really what is proliferating and what crypto have shown. Because at the end of the day, I am still a believer that assets should have utility and cash flows. At the end of the day, cash flows will win long term, but not if they don't have a user experience. They will not proliferate. So I think that this point of Wall Street is copying crypto is probably the most important comment here, because otherwise it will not succeed. So in 2012, I used to work for a company called DRW Trading, which started trading Bitcoin in 2012. And we started thinking about, well, what does it mean to trade crypto assets? And, back then it was not very capital efficient to trade Bitcoin, but, given where it is right now, it was a very good trade. But when you think about it from a capital market structure perspective, it was not very efficient. And we started thinking about, well, what does it mean to run capital markets natively on chain? We started thinking about what are the characteristics that will be required to bring a lot of institutional players to participate natively on chain. Yes, in crypto, but also, again, back then we were starting to think, well, there's 400 trillion worth of assets. If we can bring that kind of assets on chain, that would be even more exciting. And for us, it was a few components, but I would probably say that back then we said that privacy is the most important component. Back then, when it came to crypto, we were not very popular saying that privacy is a good thing because, in traditional crypto rails, if you can say that, there is no privacy. And our view was if you want, Citadel Securities, if you want DRW, if you want Goldman, if you want those type of players to provide deep liquidity on markets, they just wouldn't do it if everybody can see all of their activity. It's just, for us, that was table stakes. And the reality is that building a blockchain with privacy capabilities that are still going to be regulatory compliant, because not all privacy is created equally, is not a trivial task. So in 2016, we started building Canton, which is a layer 1 that allows for configurable privacy. And the reason why I say configurable privacy is that we don't believe that everything is either public or private, right? Like Yoni's website has a lot of elements to it that are public. He shows stock prices, he shows crypto prices, but if you want to open an account, his customers' accounts are not public for the whole world to see. So this idea that you could actually...
They actually are, by the way, right? Because we're a social network, so people share their portfolio.
They share, but you don't have to, right? Like you could actually. Again, so it's configurable, right?
It's configurable.
So this idea that the world is not binary, you have to allow for this configurable privacy. And the reality is we launched a year and a half ago, we launched the layer 1 after testing it for many years with large-scale institutions. And for example, one of the most exciting, we talked about stablecoins, is now you could actually move stablecoins on Canton with privacy, but the stablecoin issuer still wants people to see the activity. So the notional of a stablecoin movement is public for the world to see, so you could actually see how much volume is happening in your stablecoin. Who's the sender and the receiver is private. They can actually keep it. But to Yoni's point, I mean, what we're seeing today is pretty much every asset class is getting excited. You're talking about Crossroads, and you said, is it permanent? Today on Canton, we're processing close to 10% of the US repo market. That's $400 billion of repo every day, and this is not retail. These are some of the largest broker-dealers in the world, banks that are doing it. Private credit is definitely going to move on-chain. I cannot share, but some of the largest GPs are starting to put their private credit facilities on blockchain to enable much more efficient settlement and securitization, mortgages, bonds, equities, and all the way to sports wagering. And I think that the reality is what we're going to see is, I'm not going to say, but companies like eToro are going to become the banks of the future. At the end of the day, what are you looking for from a bank? Is someone to custody your assets and to provide you credit services. And really the reality is if you really remove the friction of managing assets and being able to pledge assets as collateral, borrow against these assets, right, that can all happen on your phone. And I think that that's really the direction of travel that we're seeing, and that's what we're trying to enable through Canton.
And after that promotion, I have to say you can buy the token of Canton Network on the eToro app.
Thank you.
We'll save the commercials for the end. But no. So you and Adi were saying that the Wall Street is learning from the crypto markets, but in a sense, what you're doing is with this privacy and allowing people to configure that is a lot of what had already been happening on alternative trading systems. You don't want to necessarily show people what your portfolio is or what your trading is for front-running purposes. And there's different versions that are out there, and you're just providing that option now in the crypto market.
I mean, again, for us, it's a decision. Yoni, for example, how many years ago did you start?
18 years ago.
Yeah, his whole pitch was a social network. Like you actually want to advertise your trades, and that was the whole business model. And again, that's a very clever business model. But if you are an activist hedge fund, that is not your strategy, right? Your strategy is to create many legal entities that by the time the company knows that you took over, it's too late. And again, I'm not here advocating for a business model, but at the end of the day, again, the world is not homogeneous. I mean, we heard comments about Swift. I mean, this idea that everybody can sit on just one network and then whatever some third party can have control over your sovereignty, again, is another challenge that we've seen in the last few years due to geopolitics. So the idea of canton, and hence by the name canton is from the Swiss system, where every canton has its own sovereignty and control, but they can all interoperate under one country called Switzerland, right? That was kind of the design characteristics, and what we're seeing is that is creating real excitement, because now, if you're in UAE and you want to create your payment system, that's great. We have our payment system. We can do payments real-time, 24/7 with privacy. We can interoperate with everyone on the Canton network. But if tomorrow, whatever, we have disagreement with someone else in the Canton network, cool, we won't interact with them anymore, but we still have full sovereignty and control over our own Canton.
It's a very smart feature of digital assets is smart contracts or configurable money, right? So every type of asset can basically be configured to say who interacts with that asset, what's the level of privacy of that asset, what's the speed of settlement or configuration on how does it settle. So a big part of digital assets, it's not only 24/7 trading and transferability, it's the fact that embedded in a digital asset is the fact that it's a smart asset, it's a smart contract, it's configurable, programmable money, right? And that's a very, very big change to how financial services and institutions interact today, where, I interact with Goldman, it's 500 pages of an ISDA agreement, then I need to interact with another firm, it's another 500 pages of an agreement, and the funds between us can't really move. It's very hard to move assets between financial institutions. So there's a paradigm shift, complete paradigm shift on the infrastructure of financial services to move into digital assets. And very interestingly, the fact of privacy, non-privacy. So when we started Ito, it was about show your trading activity and your portfolios, other people can copy you. That has become today in Gen Z, the younger generations, that has become not only the standard, but when you look at things like prediction markets and all of the new types of exchanges, which are the decentralized exchanges, the default is not only showing your performance, but actually showing the actual funds and the actual P&L, and people are actually sharing their real P&L online, non-stop. So when you're looking now at something that today has a lot of buzz around it, like prediction markets, you go to Polymarkets and you can actually see exactly how much this user has made, from $100 to $100,000, and what he's been predicting or betting on. So everything is suddenly on the public domain. So when you think retail, everybody wants to be sort of on the public domain and share things that people didn't expect people will want to share their actual financial transactions with their actual funds and the entire history of it, right, on the blockchain, where institutions need that configurable money for things to be private and a bit more secret.
Yeah, so this idea of it's configurable money, you got smart contracts and stuff, and so that's a perfect segue into what I want to ask Joanne about in terms of the legality, like legally, what are these things? So Joanne's a partner in the UAE office here in Abu Dhabi at the Quinn Emanuel Global Law Firm, and you get to deal with very exciting issues like how is this defined? Like what is this in law, right? And it actually is very important. It matters in terms of legal rights, creditors' rights, tax issues, and all that stuff, right? We throw around terms like digital assets, configurable money, cryptocurrencies, right? What are these things? Are they, in terms of where's the law in terms of these things? Are they currencies? Are they something else? And why does it matter?
That's kind of you, Mike, to call that an exciting question. I will try to make it an exciting answer. Yeah, it does matter. Hello, everybody. And fascinating to hear the conversation from my panelists. I'm learning all the time, so thank you for that. In the law, as ever, perhaps playing a little bit of catch-up towards the commercial developments that are happening in the wider business world, and some might say the law has been very slow to catch up with these new and exciting products. And often it only catches up when there are real problems that come before the courts that need the courts to decide important issues. Look, in the digital asset space, probably the key question that a lot of regulators and governments and courts have had to grapple with is a digital asset property? And does it give rise to property rights under the various legal systems? There were various cases coming out from jurisdictions across the world on this for a number of years. One of the first bodies to really have a good think about it was the Law Commission in the UK, where it did a big consultation and it grappled with the problem that it's not a thing in property, it's not a thing in action. So how can a digital asset be a property, because it didn't fit into the one of the two defined elements for property under the law? And the Law Commission said, yes, we think a digital asset is property, but it's a new thing. It's a new type of property. It's a third type of property, all of its own. But that was just a report, and the report said, look, we think that common law and the development of the law in this space by the judges can deal with the changes needed legally for these new products, but they recommended change. Now, I'm happy to say that the first fully argued case at Court of Appeal level on this question, as far as I'm aware, was a case here in the UAE that came before the DIFC courts. It was a case called Huobi, where a horrible set of facts came before the court, where there was a transfer of a digital currency of Bitcoin between a buyer, a seller, and a buyer, with an intermediary who was meant to help with the transfer, and the intermediary would only release the Bitcoin to the buyer once the money had been received. And there was the seller and the intermediary were innocent parties, but unfortunately the buyer found a way to access the funds in the wallet. The tokens, the Bitcoin in the wallet before it had given the money, which I won't get into how they did that, but it's a fascinating read. So the question came before the DIFC court at the Court of Appeal level, well, are there property rights in this? And actually they looked at whether the wallet was property and whether the digital assets themselves were property. And relying heavily on that Law Commission from England and Wales, the United Kingdom, it agreed and said, look, clearly digital assets are capable of being a property. There are a third kind of property, and it made the decision. It made its decisions on that basis. I mean, that case is actually will unfortunately for other reasons. Is set for a retrial, but on that particular point, it's as far as I'm aware, it's probably the decision in the world on that question at the moment. So soon after, I should say, so since then, there's been a digital assets law in the DIFC, which codifies what they found in that case, that there is a third kind of property that covers digital assets. And so I'm happy to say that in the UAE, right here in the UAE, we're making law that will I expect to be followed all around the world. It comes against a background of the UAE leading from the front on these issues. The ADGM was one of the earliest, if not the earliest, adopters of a full legal regulatory framework to cover digital assets as long ago as 2018 through the DFSRA. In Dubai, we have the world's first independent digital asset regulator, which you guys will know more about than me. But that in of its own, the fact that it was a world first, along with modern legal frameworks, has said to the world that this is a jurisdiction that is open to digital assets. We want it. We want it here. We will regulate it. We will make it a place where investors can be comfortable and where this business can grow. So, I mean, forgive me. I've spoken a lot about the UAE, but I defend that because it's a leader in its field, in this space.
I totally agree, and we'll get to that. Like we've had, the folks on your fellow panelists have set up here in the UAE, particularly for that. But I want to get to so now it's right. It's property. It's well defined in law. In the United States, the Internal Revenue Service has said for tax purposes in the U.S. it's considered property. So that's pretty. There's cases going on, pretty much settled. So from then you have legal certainty, then all the property rights and stuff then follow from that, and then you get innovation. Like that Yanni and was talking about tokenization of a lot of different things. Now, the phrase tokenization can mean a lot of different things to a lot of people. So I want to get from all of our speakers, what exactly, when you're talking about tokenization, what are you thinking about? What has promise? What has actually permanence in terms of going on, and there's a lot of folks that say we're going to tokenize everything in the future. Really? Are we going to tokenize everything? What's hype? What's reality? What's promise? Where have we actually gotten some permanence on this? So Adib, let me start with you.
Yeah, so I think so. We're still at a very nascent stage of tokenization of everything. So there's a lot of conversation on saying that you get real estate tokenized, you can get real estate tokenized, you can get money tokenized, you get capital flow tokenized. Yes, but all this are happening at its very nascent stage, and everything the panel has spoken before, and I think so we're missing out. The tokenization aspect, the transformative aspect, the innovation aspect. Well, there's a new layer that has now just come on top of that. It's the transformative power of AI. And the moment you put the transformative power of AI on all these kind of things, it now gives consumer even more power of analytics, data, ability to make more precise decision, when to move funds, when not to move funds, the ability to predict the rates ahead of time. The usage of funds, where to park funds, what's the best yield coming through. So, the transformative power of AI is also moving at a very fast pace, and that's going to be the real game changer as we move forward.
Oh, that's great. So, Yanni, I know you want to jump in here, but let me preface this with real quick. So, you mentioned as the U.S. Securities and Exchange Commission Chairman Paul Atkins he's given a lot of speeches saying we want to move the U.S. capital markets on-chain, and he's been filling in the details of that. Just yesterday, he gave a speech to the Investor Advisory Committee where he said, quote, tokenization is not just about transforming how trades and securities occur. It can also enable direct connectivity for proxy voting, dividend payments, and shareholder communications, reducing the need for multiple intermediaries in the processes as well. Love to get your perspective on that, and Yuval, then get yours.
So I think the question is there are let's talk about two very, very large databases that exist in every country. There's land registry and there's company registry, right? And there's a question of why are these registries analog, hard to access, right? So I set up a company, I want to transfer shares from one place to another in that company. There's a whole process with lawyers and accountants instead of just clicking a button. I buy real estate, it's somewhere, again, in a government registry. Why can't I sell a fraction of that real estate, right? So you look just at these two and say, isn't the user experience a better user experience when somebody owns something to be able to change the ownership in a digital way, in a simple way, right? So when you think about that, you started understanding the size of tokenization is really about potentially taking asset classes or sizes of asset classes that don't exist today, that are not transferable today, that all of their rights are not transferable, including potentially proxy voting, fractionalization, etc. So I do believe that actually the future is tokenizing almost everything, all types of assets. And I think potentially every company, even a private company, could be a digital register, so it's very easy to potentially share, pledge, sell its shares without becoming what is considered today a public company, which again, the bar always goes up and up and up. So I think when Paul Atkins, the SEC chair, is talking about moving capital markets on-chain. It's moving a lot of new asset classes on-chain, and all of those rights that are eventually property rights and the legal rights associated with those have to be embedded in law. Like in crypto, there's this saying which is very famous, it's not your keys, not your coins. And the reason for that is because Bitcoin was the first form of true digital ownership, right? So up until then, if you had a digital asset, money in the bank, who owns the money? Do you own the money, or really the bank owns the money? Because if the bank is closed or the app is down, you can't access your money. So who really owns the money? It's a third party that controls the rails, where with Bitcoin, and that was my aha moment in 2011 when I mined my first Bitcoin, and I realized, hey, I actually own this. And nobody can take it away from me or confiscate it from me because I own the keys to my coins. Now, connecting that to real-world assets, to property rights, basically connects that for what you've also, I'm doubling down, not $100 trillion, you said $400 trillion, so $400 trillion are going to move on-chain. And that is a very exciting process where you can understand also why the United States wants to take a big part of that process, of that move of everything on-chain.
Yeah, Yuval?
Yeah, I think Atkins' comments need to be taken very seriously, because I think that the word tokenization, although is a very sexy and exciting word, it's a single word that can mean so many different things. And I think that that's a bit of the problem with it, because for the most part, and your example about banks is a great one. I mean, for the most part, when you look at most tokenization projects today, someone buys the assets in the traditional world, they mobilize them, and they mint an IOU token. For the most part, most of the tokenization projects today are actually derivatives. So if you own an option of a single stock or a future on a single stock, you're not entitled to proxy vote. You're not entitled. You remember when Berkshire was the hottest company, you would buy just one share to be invited to their ADG, their annual meeting. Well, today, if you buy a tokenized Berk stock, you're not invited. You're not an actual legal holder of the security. And I think that point that Atkins brings holds something very deep in it, where when I talk about tokenization, I want to say the books and records of an asset is the token. If I hold the token, I'm the legal tender holder. I actually am entitled to all the rights and obligations associated with that security or with that instrument, like Bitcoin. And I think that that's something that, to me, is we're still, ways from getting there, because the reason why crypto to me was so exciting is when you look at something like Aave, right? Like a lending protocol. You give them Ethereum, you get USDC. And the reason why it works is because the books and records for Ethereum is Ethereum. As a lender, you don't have risk that the asset is somewhere off-chain and someone can lend or sell it or double spend it. The reality is that if I want to pledge today a tokenized equity, well, I'm actually taking risk on that broker-dealer that immobilized it, because I don't know if it's really in their broker-dealer account. All I see is a token. So I think that what I think Atkins means is we need to get to a place where the actual token is equal the asset. And to me, that's where today there's still a lot of, we just call it tokenization. And not all tokenization projects are created equally. They're not all have bankruptcy or remote protections. There's just a lot of nuance to it. And I think that we really need to get to the point that we just don't make a differentiation. I just own Apple stock. I just own it on much more sophisticated rails that allow me to move it 24/7. I can trade it 24/7. I can pledge it as collateral, but I'm an Apple stock investor. I'm not, that to me is where we need to get to when we talk about tokenization.
Yeah, I agree with you. I mean, I think, right, so Paul Atkins' point, it's not just about the trading and what we call market structure type issues. but it's that lower level, that infrastructure, the basic plumbing of this, which on one hand can be kind of boring, but on the other hand, it's things like the role of transfer agents or the role of clearance and settlement or securities lending, keeping track of all this stuff. Like, this can be transformative in terms of books and records and stuff. I mean, in the United States, transfer agent rules are so old, they've only been updated once since the 1980s, and that was in 1999 for Y2K compliance. I mean, that's how old some of this technology is, whereas with this new technology, you can come in and transform a lot of this stuff. Like
so Figure actually just now filed an S1 for a whole new QSIP where that security will exist only on blockchain. That's it. And again,
that's a publicly listed company
publicly.
That is already public, and now they're saying we're going to issue more stock, but those stock are going to be the digital stock of the company, and we're going to create a bridge between the digital stock and the real stock, so it's the same, and you'll be able to buy it on eToro. No, I'm kidding. But I'm not. But so it's very interesting because it's the first time ever a publicly traded company is basically creating its own digital version of stock.
Yeah, so I think that the point is Cagney is definitely a pioneer, saying like this is the first time. But when we look at that, we need to do that for all assets, right? Because at the end of the day, if you're an asset allocator, right, you're not going to manage your securities and then my Cagney stock, right? Like at the end of the day, what we have come to understand over the last few years, it's a funny story. We came to a big asset manager, top 5, and we did a digital bond. And we said to them, here's your wallet. And they're like, no, we use State Street. Like, go to State Street. And they're like, no, you don't need State Street. Here's your wallet. And they're like, we manage X trillions of dollars, and you want us to think about X trillion plus $50 million? That's just not going to happen. We are very excited about this $50 million, but that needs to look the same across the board. We're not going to start managing new world, old world. We need to create that user experience across the board.
Yeah. Now, let me go to Joanne. So, Joanne, you were very positive with respect to the regulatory environment here in the UAE. We at the Milken Institute totally agree with you. A few years ago, we did a study. A lot of the GCC countries were saying to folks, come to our jurisdiction. We have the regulatory framework for fintech in general, digital assets in particular. And we did a study, and we said, we basically concluded, we said the competition's really not across countries, it's within one country. It's really Abu Dhabi versus Dubai. Bahrain was probably third. Would love to get your perspective in terms of, is that still true? And then also, digital assets, it's truly a global market. And unfortunately, with that global market comes global fraud. Love to get your perspectives in terms of fraud risk in these markets, how are regulators dealing with it, how are lawyers dealing with it. When I was at the SEC, the big thing that was going on at the time was initial coin offerings. And at the regulators, it's always, we're kind of last to catch up. So we relied on law firms. We went out to the law firms and asked them, we said, what are you guys seeing in initial coin offerings? Is this really something that's really good for capital formation? Is there something else going on? And the answers that we got from the law firms were interesting. It was consistent that 9 out of 10 ICO issuers that came through the door, it was outright fraud. There was literally one called Ponzi Coin at the time. And it was amazing. They had a white paper that explained it was a Ponzi scheme, right? And they were doing that. And then out of the 1 out of 10, 9 out of 10 of those were maybe fraud, some other stuff going, really bad business plans or whatever. So we made the determination we were going to go hard on investor protection rather than capital formation, go after it. Love to get your perspective on what are the types of frauds that you're seeing out there, what are the trends, and how are regulators dealing with it?
Yeah, thanks, Mike. On the first part of your question, I think it is still right that the UAE is a leader in this part of the world for innovative, transparent, open to business regulation for digital assets. Probably since you did your your study. Did you say it was 6 years ago?
Yeah.
Yeah, probably since you've done your study, the field has narrowed. I think you're right to mention Bahrain, described by many people in the know as a pioneer in this space, one of the first adopters of licensing regulation, and they've kept up a pace with that. And I think even today, Bahrain is considered also a regional leader in this space. Look, I mean, governments and bodies everywhere are tackling the same issues and coming up with different approaches. So some take the approach of, I'm not going to be hurried by this. Let's see how the markets develop. Let's trust our own laws to be responsive. Let's take it slowly. Others have taken the UAE and Bahrain approach. Let's fast track regulation. Let's show the world we're open to business. There's a huge range. I think Qatar initially just were not comfortable with digital assets and crypto, and pretty much shut its doors. Whereas there's been a complete change and turnaround there now. And in 2024, the QFA has produced new modern regulation to welcome digital assets and currencies. So that's an example of in your 6 year in the period between your look 6 years ago and now, you would see a complete change in that country. So that's one example. You've spoken about the US a little bit. I think most people still think that the US. I know the US has had this kind of enforcement, not regulation approach historically. I understand that, but in my world, some of the early cases that relating to how you should treat a digital asset and whether it's property or not, some of those cases did come out of the States. So it's considered a really important presence in terms of regulation. It's fascinating to see what will happen in this new era of regulation, especially for crypto in the US. I've spoken a little bit about the UK. Look, other leading jurisdictions around the world, Singapore, some of the earliest cases came out of the Singapore courts, and they're very pro-regulation. Hong Kong is also pro-regulation, is having a good look now about how you treat the role of intermediaries, which is such an important element in the transactions that come before us when we get before the courts. The EU was considered to be way ahead of everybody else at one stage in terms of the regulation that had been produced. But the perception I get is that people think it's now been overtaken by other regulators around the world. Yep. And of course, some of the key laws, the key regulations that have been brought into effect, that they're not enforced in many of the EU states yet, because they have, I think, until next year to change their national laws. So a huge range of regulation and the approach of different governments and bodies, which brings me on to the second part of your question.
Broad.
Yeah, because what do you love if you're a fraudster? You don't love regulation, transparency, a documented record. You love something where there's uncertainty. I think a lot is written and spoken about this, but I think one of the challenges for this space will be some harmonization of legal frameworks across the world, because we are talking now about digital assets that can be transferred anonymously. I'm delighted to hear that actually it's not good to transfer anonymously, and there's a lot to be said for transparency and showing the world what you're doing. But I mean, the truth is that these assets can be transferred anonymously in some circumstances at the click of a button from one jurisdiction to another. Very difficult to follow in certain circumstances. From jurisdictions with different rules and different regulations. That means the upshot of this is that this is a rich space for fraud regulation and fraud risk. I spoke earlier, and you were very kind to call it an interesting question, but I spoke earlier about the legal developments that mean that digital assets are treated as property. And that is an important development, because when the sort of cases that I do before the courts in this country and elsewhere, they are typically fraud cases where we're chasing the money. It's a tracing exercise. We know there's been a theft. We know the assets have gone. One of my first jobs is always get the money. And don't wait until the end of a 1, 2, 3 year case to get the money when there might be none left. Get it now, freeze it, preserve it, make sure it's there. So I'm talking about freezing orders, proprietary injunctions. You can't get those remedies until it is accepted in your legal system that these digital assets are property.
Right. And clear jurisdiction for the regulators, because the regulators have multilateral memorandum of understanding and work together around the world.
And all of that won't work on like crypto markets. That could work on digital asset, real world assets, but on Bitcoin you can't actually do that. You can never do that. That's the core of Bitcoin. So a big part that people need to understand, there's the crypto markets that are unregulated. They'll stay unregulated because you can't really regulate the decentralized part of crypto assets. And it's also a bit of a culture statement of younger generations where regulators are coming to say our role is to protect the customers, and the customers are saying Bitcoin is here to help us protect ourselves from you, the government, right? So there's that narrative of younger generations and Bitcoin specifically saying, this is sovereignty, this is my self-sovereignty, this is my protection from government, not the need to be protected by government.
Yeah. So Adiba, we'll come back to you. So we've talked a lot about the UAE regulatory framework. Your firm, you operate 11 different countries through the GCC, India, Asia-Pacific region. You've chosen to headquarter here and put yourself in the jurisdiction. Talk about how, particularly in Abu Dhabi, it has helped you with your digital transformation.
I think so. I mean, this is a very young country, so it's have 54 years of existence, has a DNA of risk, and risk not in a very negative sense. It's a risk and ability. It's a matter that it's a trader's mindset. Every element, every government body, every aspect of organization, if it is for the benefit of the people, they would always find a way to make things happen. So around the world, you've seen the kind of listing patterns that have happened in this side of the world in the last year, and the kind of response that you have got from investors. It's because the element that the government listens to the private sector in a very close angle. They work hand on hand to find out. Was the first country to bring out an AI minister in 2017, when pretty much nobody was talking big about AI at that point of time. Yeah. It's the ability to see ahead of time and to say that, yes, if the wind is blowing towards that direction, I need to go there, I need to dirty my hands, I need to see if things can be written. I need to bring a collaborative efforts, so that means I need world to be here. And the reason, another great reason for any organizations to be here is that when you launch a product, where else in the world can you see 140 nationality to try out your products? We have 140 nationality residing here in UAE, everybody behaving in a very different pattern. And this gives an organization such as us to really bring out our product, find out these are how effective it is and how it is responding to various nationalities, how the usage is happening, and then take it out. Whatever UAE is creating. When UAE bought out its first airline, Emirates, in early 70s and 80s, it borrowed its airline. Today, it's the airline of the world. It connects the entire Africa, the Central Asian continent, the subcontinent, Far East, and also towards the Europe and US. It's become one of the most influential carriers of the world, and that has become a lot of element into tourism side. It has started to create jobs. It has given the ability to think differently, challenge the status quo, And I think so that's all reasons for me to be here. I think so it's a reason for the world to be here.
That's great. So we've only got a couple minutes left. We haven't even got to stablecoins. So I think we got 1 minute for each of you. So your views on stablecoins in terms of we're seeing a lot more use cases. What's still promise? What has actually gotten permanence in the use of stablecoins? And has it enabled other sorts of things to happen? We'll just go down the line, 1 minute each. Yuval?
So I think that, we just recently hired the treasurer of Uber to join us as CFO. And she said that in Uber, they were super excited about stablecoins or about the idea of stablecoins because, again, velocity of money, especially in our economy. I mean, when we think about technology, what is technology doing? It's just accelerating things that we do. So the velocity of money with stablecoin was very exciting. Now, if you pair that, again, as a publicly traded company, you don't want everybody just to see everything that you're doing. You don't want to see who gets paid what, payroll. So this idea of pairing stablecoins with privacy, I think, will accelerate the adoption of stablecoins.
Great. Yoni?
I think, again, here in the UAE, we're seeing obviously a huge inflow also of expats, of very wealthy expats coming to the UAE. So when we look at our customer base here, we see a lot of customers coming from Asia, from Europe, into our business here regulated by ADGM. And in many cases, they're coming in with their crypto to eToro, right? So when you move around the world and there's more and more movement of wealthy individuals around the world, crypto becomes a very simple thing to use because you can use your stablecoin as a retail individual, whether you're depositing funds into eToro here in ADGM or doing that in Australia or Singapore. So again, stable coins are already here. They're here to stay. It's a $350 billion right now, mostly USD now, very much accepted and promoted by the Treasury in the US. So it's definitely going towards trillions, and more countries are going to join. I just heard about the new AED local stablecoin that's going to be launched in the next 2 weeks. So we're going to see more and more development in that space.
Great. Joanne, thoughts on stablecoins?
Well, there's just been a very recent decision just come out of the DIFC related to stablecoins that the dedicated digital economy court in the DIFC has just given its first ever worldwide freezing order, and it was a case where it was Techtrix, where the reserves which were behind the stablecoin were moved from one jurisdiction to the other, allegedly in breach. And the court very quickly granted a freezing order over the reserve funds, as well as extensive disclosure orders against multiple parties. Really, the digital economy court, they're really flexing its muscles in this space to say, yeah, we see it, and we're here to support.
Great.
I mean, as my fellow panelists said, it's the ability to go from 24/5 to 24/7. The traditional rails just does not cater you, and it puts unnecessary cost of fund onto the businesses. So, usage of stable coins for cross-border makes a lot of sense, but I think so. The regulation is not caught up towards the use case as still. A lot of larger developing countries have still not caught up on those regulations. That makes it difficult for players such as us to use it on those kind of rails. So once the regulation catch up, this 350 could become 3.5 trillion. So it's a matter of regulatory openness to adopt those kind of rails.
Fantastic. We're ending exactly on time. So Yuval, Yoni, Joanne, Adib, thank you so much for giving your expert